Hi everyone, I'm Mirela Ciobanu, lead editor with the Paypers. And I'm happy to have with us Mr. M. As you know, the paper continues our series of articles and videos aiming to bridge the knowledge gap between traditional finance and DeFi. This year, we are going beyond the buzz to show real use cases of how we can move credit, reputation, and programmable finance on chain. As I mentioned, I have a more, let's say, spontaneous figure with us and a very active product developer or a very notorious mind in the crypto. So I won't say too much because I'll let my guests to present themselves and to share us a bit of how you have become more involved in building the Anvil Protocol, the idea behind this moving credit, reputation, and programmable finance on chain.
Yeah, absolutely. Thanks for framing that. I'm M. I'm the head of Anvil. Just a little background about me. My career is rooted in product engineering, as you mentioned. I've spent the last decade on or off dealing with blockchain technologies. I've always been very attached to its application, but I've worked for both traditional businesses and for crypto. And it sort of gives me this unique perspective because I really got to see the inefficiencies of the market from both sides. In fact, I think there's some overlap, with your papers viewers or readers, because I've done a lot in the payment space as well. Even the last company I was at, it wasn't a crypto company. It was a traditional SaaS platform where I was the chief product officer. But one of the core, one of the core parts of the product was we had to facilitate payments in 173 different countries. And so seeing it from that side and then also seeing it from the crypto side, you start to piece together where the inefficiencies are and where blockchain technologies and DeFi specifically, as you were talking about, helps to meet the need of the moment right now. And so, I was introduced to Tyler Spalding, who's the president of the Acronym Foundation, which originally created the acronym, the Anvil Protocol, through a former colleague. And we got together and we really bonded over how the financial market needs a better way of assessing creditworthiness and collateral. And that's what set us off to create what we're now calling the universal credit layer. And that's what Anvil aims to achieve.
Okay, so in a way, you kind of hinted to my next question because it was how would you explain the Anvil protocol in simple terms? And you mentioned about this universal layer. And also, I was curious to go more deeper into the problems that Anvil is trying to solve, as you kind of hint into some of this in your kicking off of the discussion.
Yeah, absolutely. I mean, so Anvil at its core, it's an all-in-one collateral management platform that allows users to issue fully secured credit. Simply put, it's a universal credit layer that any business or user can leverage, regardless of whether or not they are Web3 native. So it's something for everybody. And I guess before we go into like what it does, like you mentioned, like what are the problems associated with it? Look, I can talk for days about the inefficiencies of the global financial market. I think everybody sort of experiences it day to day, whether they perceive it or not. Everything from endemic risk. Even if you go back 20 years ago, before the financial crisis, you just see how inefficient we are at handling risk and collateral, knowing whether or not value is there. All of a sudden, poof, value disappears. There's a lot of problems with the way that banking exists in different countries that don't have traditional relationships, how international trade is done. All this stuff, is more on the macro level, the abstract level. But I think I could boil this down. I was thinking about our conversation that we had last time, and I thought of an example of something that I think sums up the problem. So a few months ago, I went to buy a new car. My family is expecting an addition, and our current seating capacity is not sufficient. So I went to buy a new car in October here in the U.S. At a dealership. We picked out the car. We went to go meet with the finance guy, And I gave them all of my information, and they ran my numbers against all the different lenders in their little program that they have there. And it came back that I had a near perfect credit score, and that's not a brag. It's just like, okay, like I am the ideal candidate, right? And here's the crazy thing: I could not get the optimal rate, meaning like certain, let's say this credit union is offering rates as low as 6.4%, but they said you don't qualify for this rate. And I said, how is it possible that with my perfect credit score and my financial picture and I'm not talking about crypto, forget about crypto, I'm just talking about in the traditional financial world, I am like supposedly this perfect candidate, and I couldn't get the best rate. And so the guy I'm talking to is like, how I've never like you're such a good candidate for this. I don't understand why. He called in his manager and they're like, yeah, oh, I see what it is. You haven't taken on enough debt. And I'm like, what kind of system is this? That because I've done everything right, I've made all my payments on time. I haven't accumulated any debt. I've worked within the system my whole life, just as my parents told me to do, and yet I'm not a good candidate. And forget what this means for people with lesser credit scores or no credit scores or the unbanked or any of these other problems that we have in society. The problem is that we're just not good at assessing creditworthiness, right? Hypothetically, I should be a very creditworthy candidate, but even I couldn't prove my creditworthiness, right? So there are inefficiencies that are baked into this whole problem. And when it comes to assessing creditworthiness, I talk about this a lot. There's really only two ways that the traditional market knows how to do it. You can either go based off of trust or history. So that's basically what they're doing there. They're saying, okay, have you made your payments on time? Has other financial institutions trusted you? All that other stuff, which is a very imperfect system, right? Because it requires subjectivity and middlemen. And you see all the ways in which that approach has led to problems in the past, right? Or you can secure something like collateral, but the problem with traditional collateral is that it's either illiquid like a house or a car or something like that, that its condition and value isn't necessarily known. You have to pay people to repossess. There's all kinds of problems associated with illiquid collateral. And then liquid collateral, we just don't have a good way of possessing outside of going with third party escrow or something like that, right? One of the things I like to say is there's no way for me to say like that money in your bank account, you got to hold on to that just for me because I'm giving you a loan and I need to make sure that money is there. Can't do that, right? The best you could do is like an ACH hold or a credit card hold for a couple days or something like that, right? So because we don't know how to do all of this, there's all this inefficiency baked into the current system, right? And that's before you get to crypto, which is such a huge problem, right? Because if you try and go and get a mortgage, you say, "Hey, I'm a crypto guy. I got all my money in crypto." Are you going to walk out with a mortgage or a favorable rate? No, right? And that's the problem. You're telling me that $2.5 trillion in market cap just doesn't count towards the financial system? I mean, this is why we set out to create Anvil, is to address that exact inefficiency because it is inevitable that crypto is going to be a part of our lives. It already is. You look at more than 50% of Gen Z owns crypto. They're not building credit, so they're not building the history and the trust-based stuff. And the only collateral they really have, because they're not buying houses, is they have crypto. So somehow, if you believe the markets move towards efficiency, we're going to have to recognize the fact that crypto is part of our lives that needs to be assessed, it needs to be evaluated when figuring out people's creditworthiness, right? So that's super important. But also, like the underlying system, like these two things don't have to be at odds. The crypto users versus the traditional market, and a lot of things that are specifically endemic about crypto actually can benefit the traditional market, whether or not they view it through the lens of like adopting crypto or anything like that, right? And it's because decentralized. What I like to say is digital assets make the perfect collateral, and the reason is because they're 100% liquid. Their price is always known. You always know their condition, and the market for them is open 24/7, 365. And even though we couldn't do that thing where I say, hey, that money in your bank account, reserve that only for me, you can do that with smart contracts through blockchains like Ethereum. And so that's what we built with Anvil, is this ability to be able to provably reserve collateral for the purpose of proving your creditworthiness.
Yeah. So in a way, you kind of made here some parallels of how traditional market operates when it comes to credit, assessing credit or worthiness. And you mentioned here that there are some inefficiencies. And then on the other side, we have the Anvil protocol that tries to solve some of these inefficiencies. And when it comes to traditional market, I have this feeling that everyone from our audience is exposed on or knows what are the exact components of how does this system is working. In a way, it's not working because you mentioned you were the perfect candidate and you still didn't got the loan. Yeah. And now, I was curious to see if you think exactly on the technicalities, on the core components. How does the Anvil protocol, what are its components that are crucial in a way to kind of not necessarily duplicate the traditional market because it aims to solve some of those inefficiencies, but to understand better what are the mechanisms that we need to take into account. And also, maybe regarding the components to see, because you also mentioned this idea of trust being important. How is trust being engineered into these decentralized systems?
Okay, yeah.
So I also like to talk a lot like you.
No. If you don't stop me, I'll keep going. And no, that's a great question. There's a lot of pieces to that. But yeah, at its core, all the protocol does is it takes digital assets and it allows you to provably reserve them for the issuance of credit. That's it. That's the whole thing. Now, I can talk about the individual mechanisms of, we created this concept called the digital letter of credit. So I'm sure a lot of your your viewers are familiar with how letters of credit work in the current world. We created a purely digital version, right? We allow people to participate in staking pools, facilitating loans and lines of credit and all kinds of things like that. But at its core, the thing that I want to focus on before we talk about all the different mechanisms, the ones that we've built and the ones that are on our roadmap that we're building, let's talk about why it is so radical. Why it's so exciting that you're able to provably reserve value on a blockchain for a specific purpose. Because that is, even though that seems so basic, like I said, this doesn't exist in the traditional world. So what does that mean? That means you can fully secure credit. That means that I can make you a promise for a certain value and and I know that value, and outsiders know that value is always going to be there. And that it's not whether or not I decide to move something around or a third party or subjectivity, it's technical conditions that are holding that. So now you have fully secured credit in a way that you don't have in the traditional market. So now what can you do with that? Well, imagine, if we're just thinking about this from the traditional business perspective, imagine I'm a lender, right? What can I do with that information that I know, hey, there is no way this person can default because I know exactly where that value is and it's pledged to me. So now all of a sudden, what? I don't need, now interest rates are just how much money I'm going to make off of this. It's not the way that it works right now with the inefficiencies we're talking about, where because, let's say, 3% of all of my customers are going to default, I have to charge everybody higher interest rates, right? Think of the way insurance works in the United States and all that stuff is like a certain amount of people are going to get sick, blah, blah, blah. So because of all that, you need to be able to cover that and make sure I'm going to make money off of it. But that inefficiency is built into, that risk is built in for everyone. But when you remove risk from the system, because you have this guarantee of fully secured liquid value that can be grabbed at any moment, now all of a sudden, what can you do from as a traditional lender? You can completely undercut the market. Everybody else is lending at 7% right now. You can lend at 2%. You can lend at 1%. And it's just a matter of how much profit you're going to make off of all this, right? You can both keep your competitive edge, be more competitive than the competition, but you can also, your 100% of that is going to wind up coming in, as profit to you because there's no chance they're not going to default. So when you have something like that, when you have a guarantee like that, you can do things like collateralize payment networks or build an entire futures market or anything like that, and just know that the system itself will preserve the value because things can't be rehypothecated. All this is in the technical conditions without going too far into the weeds on that. But the idea that you can have fully secured credit opens up a world of possibilities for use cases, right? So when I say that, oh yeah, all it really does is reserve value, this is something that doesn't exist in the traditional world and is going to make everything more efficient and remove risk from the system. And so now I'm remembering you asked about trust. The beauty of this, you don't have to trust anybody. Okay, caveat that. The system itself, the technical conditions, the thing everybody can inspect and see, the things that we have audited. We have audited over and over and over again, the core protocol. Every time we add a new mechanism, a new way to leverage collateral as credit, to obtain credit, we get that audited as well by the gold standard of the industry that does blockchain auditing, and we publish all of our audit results, right? But if you trust the technical conditions and you say, look, there's no technical way that this value can be removed, people can get quote unquote rugged. That's a big term that everybody uses now, and it's made its way into the mainstream. Then you don't actually have to trust anyone, and that's the beauty of it. You don't have to have credit checks. You don't have to have KYC. You know,
In the traditional
you wouldn't have
way,
exactly.
yeah.
You're just an address, and I don't need to know you. I don't need to know your name. I don't need to know your birthday. I don't need to know if you were, if you came out of prison and don't have a bank account, or it doesn't matter, right? Because as long as you can have proved reserves on reserve value on chain, we can do business and we can offer financial products to anybody, right? It's no longer how much do I trust you? How much when you talk about, there's two things that I think the traditional world is going to get very excited about when they really understand what this tech means. The first thing is you have this whole user cohort of crypto people, right? The younger generation. I mean, the older generations are doing it too, but not at the same rate, right? You have all this user cohort. You can say, wait a minute, now all of a sudden we can offer our financial products to them because there's a system that bridges the gap between the thing I care about, let's say US dollars, right, versus the thing they care about, their Bitcoin, right? This system can decentralize in a decentralized way, can bridge that gap without an intermediary, without needing to hold on to their funds or anything like that. A decentralized system works for that. So now I can offer my product to more people. That's one. Two is the existing way I've been doing things is ripe with inefficiencies, and this has helped solving it. I mean, I don't need, if I was so let me give you an example of something that has popped up a lot in the last few years, right? You see buy now, pay laters. They're everywhere, right? The Affirm, Afterpay, Klarna, all those guys. Everybody's getting into the buy now, pay later space. And the reason is because you have this generation of people that don't really have traditional credit history, but they need to get access to short-term loans for larger purchases, right? That's why we have buy now, pay later. What you realize from a business perspective is there's a lot of user friction at that moment of purchase. It's like, I can't pay for it now in full, but I can pay for it over time. So we've reinvented sort of the layaway system that used to exist back in the day. But buy now, pay laters are entirely trust-based, and that's how they can, there's a limit to how much they can lend. But if their users have crypto as collateral, you can actually completely supplement all this to the point where Anvil is almost like a built-in buy now, pay later. I can prove that I'm good for a certain amount of money and then act on it later. And that's exactly what we just announced a few weeks ago. We were doing with this large crypto conference called Consensus, where their sponsorships, which oftentimes run north of $100,000, their businesses that are sponsoring events can secure their sponsorship with an Anvil letter of credit. I mentioned before, we have these different mechanisms. Letters of credit are one of them, and then pay for it later. And at no point is the conference organizer confused as to whether or not they're going to get paid. They don't need to even hire an accounts receivable department eventually because there's nothing to receive. It's all there on chain instantly. You don't need to worry about net terms and, hey, are you going to pay me? Do I need to, like all that stuff, all the worries that traditional businesses, remember, I've spent a lot of time in the traditional business world too, hunting down clients for things. It's like, if you can make a decentralized promise, it is instant and direct and free, and you can do that and know that there's no way you're not going to get paid. The world just opens up as to what is possible. So a lot of times we use this example. Tyler sort of coined it, but you think about like a cashier's check, right? This like is basically as good as cash, right? You get this check, and the bank is standing behind it and saying like, this is guaranteed for the amount, right? What you do with that check, the use case is, the sky's the limit, right? I can use it for a down payment on a house. I can use it to secure a loan or a line of credit or do business or anything like that, right? We're just building the tools, these modular building blocks that can be used to modernize the financial system for the better.
Yeah. So you mentioned about the use cases. And you mentioned the example of buy now, pay later. Then you mentioned your example with securing a loan that gives me this idea of more like, I don't know, retail consumers. But then you also mentioned the consensus event. And here it takes me more to this, let's say, SME enterprise level. So now to kind of make it clear to our audience, who are the primary targets for the Anvil protocol today? And what are the prerequisites for users that want to join? Do they need to be crypto native or not? So just to clear up this, categories.
Yeah, absolutely. No, great question. So yeah, like I was saying, if we were the inventor of the purely digital cashier's check, right? The use cases are seemingly endless, right? So the use case for a targeted user could be a retail investor that wants to get a loan against their long-term crypto holdings, right? Or it could be two large enterprises, multinational enterprises doing business, between countries that don't have traditional banking relations, right? I mean, it could be
also, sorry to interrupt, if you have also names or examples, or maybe share some links later on, we can share them with our audience as well, because they are hungry for use cases.
Yeah, exactly. Okay, so let's talk about the letter of credit model that we were talking about before, because I love this. We talk about the small things in terms of what retail people can expect to get from the kinds of companies that would integrate to offer them loans or lines of credit or anything like that, or accept the buy now, pay later model where they're pledging collateral in the form of digital assets. So traditional letters of credit, right? An example of a traditional letter of credit, which I'm sure all of your users are familiar with, would be something like, I have a business and I want to be able to have a factory in Shanghai manufacture units for me, and I'll pay them once it gets delivered, right? Well, you have this problem. First of all, you have the trust problem. You're going to keep finding out the word trust comes into a lot of things when it deals with inefficiency, right? So I need to be able to prove my creditworthiness to that factory in China to say, no, we're going to pay you if you make 200,000 units of this thing that we intend to sell, right? So what happens? What happens is I have to go to my bank. Since we don't have traditional banking relations with China, I have to go to my bank. My bank is going to make a guarantee on my behalf to the factory's bank in Shanghai. They have to work together to create an arrangement. There's legal process involved. It often takes days to weeks. There are fees that we pay, all so that I can make a promise to that factory in China, right? Think about why are there 4 parties involved for a 2-party? I just need to prove something to the factory in Shanghai. Why am I paying fees? Why are there middlemen? Why does it take days? Why do I have to worry about banking hours and people on the other side of the world? Right? So what we did by creating a digital letter of credit is it's a peer-to-peer promise that's instant and direct and can happen at 2:00 in the morning. And all of a sudden the Chinese factory says, great, we can start production because we have this guarantee. We know that we're going to get paid if we need, like that we're going to get paid once we produce these units. That's what this unlocks. So I know we talked a lot about the retail stuff, about how do you get loans against your crypto and all that other stuff. But at a macro level, this is why this opens up so much with regard to international commerce and trade and all this kinds of stuff, because all those inefficiencies, I mean, just think about in a free market, time to market matters, right? If you want to be the first one to market, you want to have your product made faster and all that other stuff, right? If I'm waiting 2 weeks to get a letter of credit and paying for it, and then my bank is on the hook to their bank, it's just inefficiencies that we can solve endemically with digital assets. And that's the thing, is that at its core, so I guess there's this question. People sometimes ask me in our community, they're like, so are banks going to exist in the future?
Exactly. So in my mind was alert, what our banking audience is going to say. Is there going to be any place for us in the future?
Yeah. And the thing is, absolutely, they will. Their product offerings might change, is all I would say. Okay, so maybe you don't have the bank charging you fees to facilitate a very boring and unnecessary middleman operation, right? But remember, Anvil isn't necessarily the bank. You can sort of be your own bank in this model, depending on how you adopt it, and there's ways to sort of get loans yourself and all that stuff. But ultimately, what we're talking about is we're talking about the bank that's only been able to offer the financial products to users in the traditional world are now able to offer those financial products to the crypto world. So now all of a sudden you're expanding their user base. There's more of a need for the people offering financial services. We're just going to see more of them pop up, and they're going to be much more efficient. And they're going to need less people to run, right? And they're going to be able to keep more profits because we've removed risk from a system. I think a lot of the people that I've spoken to at larger banks in the traditional world actually get excited about this because they realize this is an inevitability. But the thing that they worry about is exactly what those people in our community are asking about, like, where do we fit in this whole thing? And the answer is they actually make more profits with less people and less inefficiency, right? So it is it is a true modernization. It's not an either or. It's not a them versus us. And one of the things so we talked about trust a little bit earlier. One of the things that becomes difficult is the user hurdle. I've been in crypto, like I said, off and on, but sort of since the early days of decentralized applications and everything like that. And the biggest user hurdle has always been getting users to understand what they're doing, because they're not all set up to digest the technical conditions and understand how to interact with smart contracts and all that stuff. But we've gotten better and better as an industry over time of making more user-friendly tooling. And ultimately, when I say that Anvil aims to be the universal credit layer, it's exactly that. Things that back office things that you don't even need to think about, that are just built, that are just like on the foundation of something. You could totally have an integration where that looks to be between users and a bank in the most traditional sense, and it just looks like their interface and everything like that, and not even realize that under the hood there are digital assets securing all of this, that this layer exists that they don't even see, but it's making everything more efficient and quick, and they'll notice the benefits of it. So whether or not you want to be on the vanguard of what is possible with crypto and being involved like in the actual smart contract level, or whether you just want to be a passive user, this is why we're making this modular, and this is why we're making it flexible, so that the way how much of the integration you expose to your users is sort of up to you in terms of how you use it. Because you could totally imagine how Anvil could facilitate financial controls and compliance stuff under the hood that banks have to deal with all the time, and not even have it touch the users yet, right? So it's because of the flexibility that who the users are and how they use it, it's sort of the sky's the limit when you have this technology, adopted. And like I said, it doesn't mean an existential crisis for the banks. It just means more efficiency.
Yeah, and to be honest, when it comes to getting users to understand stuff, if you think also in traditional finance, you have this need for financial literacy, that for people, that many people don't actually know how traditional finance works. And in a way, because I have this feeling that DeFi Web3 comes with a new, fresh perspective approach on educating users via gamification or other means, in a way it's much more cooler, and I think it's more efficient to get to that financial literacy that also the traditional finance world aims for.
Yeah, absolutely. So let me riff real quick on something that I think is important, and I think will resonate with some of your users. Now, granted, the financial literacy problem is it's an interesting challenge, because the crypto industry, it depends on, there's all kinds of perception from the mainstream world as to what it is. Now, the good news is the Overton window is sort of shifted on that, and people get exposed to it more in their regular life. And we have a lot of institutions like, Coinbase and all that look and feel like traditional banking. And because of that, I think there's more trust there. But at the end of the day, I'll go and speak at a conference, and the guy next to me will be like, "Oh, I put a hat on a dog and you should buy it." And you're like, we're trying to modernize the financial system. What are you talking about, a hat on a dog? It's crazy that these two things exist, but the core technology here, there's real application for use of it, right? So one of the things that I like talking about that I think is so revolutionary about digital assets and why this is exciting is the underlying collateral that you use can inherently appreciate in value or be natively yield bearing, right? So why is that exciting, right? Imagine that the traditional people will definitely understand borrowing against your 401k, right? Mm-hmm. It's like, I have this thing, I need access to liquidity, I'm going to borrow against more 401k, right? You expect your 401k to go up. Now, I know that that's a US based term, so whatever it is, an investment account or whatever, right? But when it comes to capturing yield, large companies are set up to do this fairly well, especially in financial services, right? If you give them even just a short window of time and some extra liquidity, they can earn money off of it. But the individual can't, right? And because of problems with the, like I said, you can't reserve liquid collateral very well in a traditional system. What happens is we rely heavily on prepayments. So all these people are paying in advance of when they need to just to be able to secure something. That's sort of that buy now, pay later thing we're talking about. It's like the only way for you to be able to secure, this booth at this conference, this sponsorship, this $100,000 sponsorship is you got to give me $100,000 right now a year in advance, right? That's really inefficient, right? And if you think about it, like, what could I have done with that $100,000 in a year? You know what I mean? Versus having to give it to you just to be able to say, hey, I'm going to be good for it in a year. Well, now the beauty of DeFi is that you have these digital assets that inherently earn yield. So even if you have a token that is yield bearing, let's say it earns 10% a year or even 8% a year on a $100,000 principal, you could expect to earn $8,000. So if you pledge $100,000 worth of this token that and there's plenty of them out there, right? One of the examples that we use with Anvil, we have SUSDE, which is a Athena based staked US dollar, which will give you about 8 to 10% depending on where they're at. I can make a promise to you for $100,000 to prove $100,000 worth of US dollars, or USDC or USDT, whatever the crypto equivalent that you want to accept is. And then a year from now, I go back and I make the payment, I fulfill the financial obligation, I get my collateral back. Now that's worth $108,000. So I didn't miss out on the opportunity over a year to earn on that principal that was just being used to reserve something, right? So that's why DeFi is this great equalizer, because it enables any individual the ability to earn natively just by owning a token. That's a financial product that doesn't exist in the traditional world. You'd have to buy treasury bills, and then you need to be able to pledge that against something else. And there's no good system to do things like that, right? But with each individual token, because it's all on-chain, because it's provable, because it's liquid, it enables people to be able to earn even while their assets, their long-term holdings are being used to facilitate financial products. And that's sort of the goal with Anvil, is that you take all of your long-term holdings, you keep them in Anvil, right? And then you use them where some over here, this is being used to guarantee my mortgage. And this over here, this is being used to get this on. And this over here is being used in the staking pool to earn. And all of this, it doesn't need to affect your long-term financial picture to be able to access financial services. And that's why this is sort of the great equalizer, that the individual users or businesses can have their collateral in something that works for them, while promising something in the form of something that makes sense to any integrator that would accept this, like US dollars, right?
So we have the novelty of these products. And then you also mentioned about the perception with the dog with a hat. Where I want to hint is the fact that for many of our audience with a traditional background, this may sound as, a question of risk, governance and regulation, because it's new things, things that maybe we don't fully understand. How does Anvil address these topics?
Yeah, absolutely. So in terms of governance, so it's important to note that there's a couple different layers to this. Anvil, the protocol, and this is the core constructs that we're talking about here, is entirely decentralized. And so what that means is that Anvil governance token holders get to vote on any changes that happen to the protocol. So even though, let's say, like, I'm the head of Anvil, or we're just doing research and development for this protocol, but ultimately it's up to the token holders as to whether or not any given change is accepted, right? And this includes everything to what kind of collateral do we accept, what kind of what market conditions do we want to allow certain things, for, or if we want to upgrade a contract, and, all that, all the kinds of technical changes that you'd expect that normal companies can just push out. You could have an engineer that didn't really, leaned on the keyboard wrong or created a bug, and we see this all the time in the traditional world, and sent it out into production, and the next thing you know, you have this big problem, this big financial problem that was created by somebody that pushed something that wasn't well scrutinized. Well, the beauty of decentralized governance is that everybody looks and analyzes it, and only when enough of a voting threshold decides that it's worth adopting does it actually get adopted and put into place. So we have a fully decentralized protocol, so that it's, the more eyes you have on it, the better. That's like one of the ethos of Web3, is that you can make decentralized decision making. Now, in terms of risk and all that, just because you're in DeFi does not mean that it's entirely trustless. So what happens is you do have protocols out there where if you actually look at how they're governed, there's plenty of backdoors. There's plenty of ways for, the core team to be able to make changes without, taking it to the token holders or whatever. Anvil is entirely decentralized. So there's security in that. And there's also like risk in that, in the sense that you're trusting a collective of people to be able to make decisions that are in the best interest of the protocol. But the good news is we have, the economics of it, we've worked it out so that the people that hold these tokens are really, for the most part, are people that really are invested in the space and want to see the modernization of this happen. And this is why we're sort of expanding our governance more and more to be able to efficiently govern something that's going to be a larger and larger part of our lives. And so, yeah, like I said, everything gets audited on the core contract level and everything like that. In addition, we at the project, the foundation, build tooling that helps make it easier to adopt. But importantly, all that tooling it's just an interface on top of, or it's, APIs, or it's, it's just a way to be able to interact with this stuff easier. But at its core, anything that's financial in nature is coming from the core protocol, and that core protocol is fully decentralized. And there's a lot of benefit in moving to a model like that.
Yeah, and quick question regarding the voters, because you mentioned that you need a sufficient threshold of these voters to kind of, do a modification or not. Can you tell me, I don't know, thinking, because I have this feeling that you met some of these people face to face, because, they are persons behind. Can you name some 3 features of these voters?
Sorry, the
features, qualities, or if you want to
listen, we don't know. I know we know some people that have the tokens, but like,
I mean, so where do this question comes from? So many times, I don't know, people in the DeFi are kind of labeled, I don't know, like libertarians, or with very extreme words, or I don't know, they are indulging into stuff. And I was curious, from your perspective, because you are in the domain there, if you are to say some features.
So what kind of people participate in decentralized governance?
The voters. Yeah,
it's actually a really good question. So I think there's 2 kinds of people. If I were to broad bucket it, you have people that buy tokens because they think, and it's not just, I'm talking about governance tokens, like specifically meant to govern protocols. Some people buy them because they view it as a quasi investment in the space or in the tech, and they think it's inevitable, but they don't actually want to participate in any of the voting. So that cohort definitely exists. And then you have the people that are trying to do its intended purpose, which is to facilitate that governance. And those are the people. This is why we have communication platforms like Discord and everything like that. So when we have a proposal for a change to the protocol that goes up, there's a place where everybody can come and discuss the change, understand what it means, what the ramifications are, to be better informed about whether or not they should be voting for or against it, right? So you do, I will say that our protocol, we're very lucky that we have a very fervent community of people that when we initially distributed the token, and we did it for free to all these people that were had already invested in the space of on-chain collateral. So these are already people in the mindset of like, hey, we think this is the future. And then we gave them the opportunity to participate in our governance and say, wait, now you get to help like shepherd like what the future looks like. Like I was saying, this is an inevitability that these kinds of problems that we've been talking about are going to happen. It just depends on who is going to be the one, what is going to be the protocol that's going to be able to be that layer in the stack that becomes there's no point in building this layer, reinventing the wheel over and over again, because there are other protocols that handle collateral and quasi creditworthiness, if you will. But that's just one little piece of what they do, and they don't focus on it exclusively. So we aim to be like the layer that it's like everybody can base things on, and then build what your core competency is on top of it, right? So the people that we gave the token to initially are the people that are already in the mindset of, thinking in the future and saying like, how do we want to usher in this modernization of the financial system? And they're very opinionated and engaged, and that's very exciting to see. And even the last one of the last proposals we had over like 10 billion votes get cast, which is more than 10% of all the tokens in supply. So it's like unbelievable levels of participation that we see on some of our protocols, and I think people are just really excited about what this means, not just for them, but what they want to see in the world, the changes that we want to see.
Yeah.
And Anvil is one of these. I hate to be like, right place, right time, but it's just one of these moments where it's like we are reaching this reckoning, but it doesn't have to be a revolution. When I first got into crypto, there was this whole talk of this revolution where the banks are going to go down and we're going to run this stuff and all that, and that was never really going to happen. Anyone who's attached to the real world and all that, but like I said, these two things don't have to be at odds. The traditional businesses, it gives much more power to the individual, and I think you're going to see a shift over time of individual consumers and smaller businesses having access to the financial products that are typically reserved for larger businesses, and that's what we intend to do. So a lot of our voters get very excited about this future and want to help shape it.
Yeah. Actually, yeah, it's nice to have a cohort of people that find meaning in what they do and have a specific purpose than just, I don't know, to think about their job as a 9 to 5 thing. So I think this positive energy gets translated into the product and the outcome of it.
Oh yeah, I mean, if I come off as like excited and verbose, which I know I do, it's only because I'll go to these conferences, and even in the ones that I'm not speaking, I'm just meeting people. People come up to me and start talking to me like, "Oh, I've been following your project," and they have they want to talk. They want to talk in detail about the different technical mechanisms we're building and all of that stuff. And that stuff just gets me really excited, because if I was just doing this, with a few guys in a basement somewhere, it would be an exciting side. I still think the world needs this, but the fact that we have a community that's really engaged, it's not about me. It's like I need to deliver for them. You know what I mean? Like it's all part of this collective. So it's nice because anyone could propose an upgrade to the system. It's not just us, but we're the ones working on it full time. And then because of that, I wind up finding myself having to explain to a community, why we're doing this particular change and why, we've introduced this new mechanism or anything like that. And I get excited to explain that. So obviously you've probably seen this. You give me an opportunity to talk. Yeah. I'm going to talk.
Yeah. Actually, yeah, you hinted at the beginning that the answer should be short or long, and I said, but I'm happy because we're almost there, and we cover so many things. And you hinted about the fact that these people are also visionary on how the finance world would look like. And I'm curious, what's your vision? How it will evolve over the next 3-5 years? And are we moving toward a hybrid financial system where traditional finance and DeFi coexist more seamlessly? Or are you going full on DeFi, or how do you see things?
So I mean, for sure, this is just one guy's opinion. But I think there are certain, if we go back to, the idea that markets move towards efficiency, and that if there is a way to make more profit, if there's a way to use less effort, eventually the market will find its way there, right? So because of that, that's why I start to say that this Anvil is an inevitability. Now, I don't necessarily mean Anvil specifically, but it means the challenges, the problems that we laid out earlier have to get addressed, right? I mean, you have this radical problem where generations of people have this thing that the financial sector doesn't know how to deal with, right? So that's a problem that needs to get addressed right away. It's an existential crisis to the financial system. But you also have this efficiency thing, right? The fact that the current financial system is sort of duct taped together in a lot of places to try and work, and its inefficiency is passed on to everyone, in the form of administrative fees, higher interest rates, things like that. So I think inevitably these things will come on chain. It's just way easier. And instead of it being like, do they coexist? I think what'll likely happen is you'll start to see more of what I was talking about, where the blockchain layer happens in the background. where users will just start to notice like, oh, I can get financial products 24/7. I don't need to wait for, oh, Monday's a bank holiday, so Tuesday I can get access to my loan or whatever. They'll just start to notice more and more is possible quicker and more efficiently ultimately. And there'll be the companies, like I said, that take advantage of this technology more under the hood and less exposed to their users, and they'll be the ones that market specific to their users. So whether or not every individual in the world starts to own crypto themselves, I don't really know when that happens, if that happens. But what I can say is the efficiency stuff, 100% like is going to have to get solved. And if you believe the markets move towards efficiency, they'll turn to blockchains for this. And you've already seen this happen. This is not like a us versus them thing. You see all the big investment banks start to take massive stakes in Web3 companies because they realize this is the future, and it's just about getting people from A to B at this point. So I think rather than a hybrid system, I'd say a fully integrated system, and just the level of integration, whether it's deep below the surface at the creditworthiness layer, or whether it's up on top with hey, I own this crypto. How do I access financial services using it as collateral? Remains to be seen, but we're gonna get adoption one way or the other.
Yeah, I made here round design here, and I have something like inefficiencies, but then you have efficiencies, but everything is in a way servicing the people. I mean, there are some inefficiencies in financial services regarding how people access money or resources, but then you have also people working towards these people having the inefficiencies solved. And the whole raw thing that I draw is the Anvil Protocol, because I love how all things blend, and all here you have traditional with new, you have technology but with people, and you have real problems with real solutions. Because sometimes there is a joke that there are solutions in search of a problem.
Search of problems,
but here we
totally the opposite here, right? And this is why we're I'm so gung-ho on the universality of it. And this is why, instead of building a very prescriptive system that says like, okay, we're going to build an on-chain loan system that works this way and repay all that, instead of trying to say, hey, here's the use case, the specific use case we're trying to solve to, we went to the infrastructure layer and we said, how do we build these building blocks on which the financial system can exist, right? And that's why we created the individual mechanisms that we have within the protocol. And then, like I said, it seems kind of cheesy to be like, oh, the seemingly endless use cases, but really, like I said, if you were the inventor of the check, right, now all of a sudden there's so many things you could use a check for, right? So it's like we started there and then started building use case specific helpful tooling on top of it to make it work for different industries, right? So it's very exciting, the universality of it and how everyone can use it. And it's very rare in life. And it's one of the reasons that I got pulled out of like I said, I started in crypto. I started outside of crypto, went into crypto, came out, went back. One of the reasons that, Tyler was able to get me out of my position in the Web 2 space, leading the product for a SaaS platform where I was doing pretty well, was because I fully believe that there's very few times in life where you get like a win-win-win, where it's like, usually it's a zero-sum game. Usually it's like, we're building tech that's going to screw over the users and it's going to benefit the banks. Or, what crypto was at the beginning, at least the thought was, we're building stuff for the individual and we're going to screw the banks. And you're like, yeah, you know what? That doesn't really get adopted, because the people that need to accept the tech are the ones that stand to lose. But the fact that I see investment bankers and I see individuals excited about the same tech means there's a problem that everybody recognizes that needs to be solved, right? Greater profits over here, better access to financial services over here. And the third win is the fact that you have this industry that people also want, that's tied into the whole thing. I have these digital assets. How does this participate in the whole thing, right? So not only are you making both sides more efficient, where ultimately it's costing both sides less, which is very rare. Sorry, banks, you're not going to be able to charge middleman fees, but you're going to be able to offer financial services to everybody. And you're going to be able to
access fully secured credit, which is incredible because now there's no default risk. Imagine, all of the credit industry is we like to say $250 billion. Imagine that with no risk. That's crazy. It's crazy to process how much, yes, some middlemen are going to have to go out of business, but everybody is going to be better for it. And it's going to create much more opportunity, financial freedom for the individuals and for businesses.
Yeah, great. Thank you. And I was curious before we end, because I was about to say thank you, Em, and I look forward for our next conversation. Maybe to our audience, a small explanation behind the slightly anonymity of your name.
Yeah, absolutely. I mean, I'm not overly attached to the pseudonymity of my name. It's more just the fact when I started, when I started with Anvil, I didn't know how outward facing I was going to be, and I wanted people focused on the tech. And we have a very fervent community of people that follow the project that are very into the palace intrigue aspect of who everybody is and where they came from, and obviously for business development and all this stuff under the hood, like I use my full name, but when I speak publicly, I sort of just needed a name to just answer people on Discord, and it sort of caught on. So then people just started referring to me as M, and so ever since then I've just been speaking as M, and I'm sure at some point, the world will, know my name, but for right now, like it's not about me, it's about the tech, right?
Exactly.
So that's what I like people focused on, yeah, I'm just excited to be talking to you. I mean, like, there's so much more that we could talk about, maybe in a future conversation about payments, about how, Anvil is being used to collateralize payments on the world's largest purely digital payment network. There's so many different use cases here we didn't even get to dive into, but I'm excited to have talked about the problems, that exist in the financial sector and how Anvil is trying to tackle them.
Great. So this episode will appear in April. So then we have a plan also for May, June.
Sounds good.
Thank you. Okay.
All right, thanks so much.
Yeah, we'll keep an eye on Anvil and continue our discussion. Thank you.
All right, thank you so much. Bye.